Banking used to mean brick and mortar. Now, in developing markets, digital infrastructure is bypassing traditional physical institutions entirely. Sub-Saharan Africa has become the primary laboratory for this shift, serving as a leading engine for financial technology innovation. This growth is built on the ubiquity of mobile money. Services like m-pesa have turned basic cell phones into accounts, creating a foundational layer for digital finance that reaches nearly every village. But all of that success hides a deeper paradox. While simple peer-to-peer transfers are everywhere, the adoption of complex platforms like decentralized lending and crowdfunding remains low and highly uneven. The basic transfer infrastructure is a fixture of daily life, yet users frequently hesitate to adopt more complex financial products. Standard behavioral economics and adoption models struggle to explain this friction. They fail to predict why users engage with simple transfers but reject the broader digital economy. To identify the source of this hesitation, researchers analyzed the intentions of 818 digital finance users. The data centers on 4 key markets: Ghana, Nigeria, Kenya, and South Africa. The findings suggest that scaling complex finance in these high-friction environments requires a customized behavioral framework, one that looks past the assumptions of more established markets. Standard technology adoption models like TAM and UTAUT are the industry's default tools for predicting behavior. They operate on the assumption that if a system is useful and easy, it gets adopted. That logic often breaks down in the financial sectors of developing economies. Standard models tend to treat systemic risk as a monolith, a single unnuanced variable that ignores the specific fears of the user. They also frequently oversimplify the role of trust, treating it as just another predictor variable sitting alongside ease of use. Because of these blind spots, a platform built using standard models might be easy to navigate, yet remain poorly equipped to handle the specific systemic friction found in emerging markets. To create a more accurate predictive tool, researchers rebuilt the UTAUT model using pls-sem analysis. The process begins by isolating the positive drivers, the factors that actually move users toward adoption. This blueprint maps system enablers. Traditional drivers like performance and effort expectation remain statistically relevant for users. However, the critical driver here is economic benefit. Users migrate primarily for clear cost savings over traditional banking. Once benefits are mapped, analysis shifts to inhibitors, shattering the idea of risk as a single category. The empirical data breaks risk into 5 distinct subconstructs. Users calculate 5 separate threats: operational, legal, financial, security, and privacy. This separation is confirmed by discriminant validity. Specifically, the hetero-trait-monotrait ratio proves that users cognitively distinguish between these risks. They do not view a potential system failure as the same threat as a data breach. In this specific regional context, legal risk from regulatory gaps and security risk from cyber threats are the most significant inhibitors. This means developers cannot address risk broadly. They must design surgical mitigations for each specific subconstruct. Decoupling these risks reveals the mechanical function of trust. Standard models often treat trust as just another isolated feature to be built, but the relationship here is more complex. First, high perceived risk directly attacks consumer trust. Concerns about legal uncertainty or data security drain baseline confidence. In the second phase, trust acts as an interceptor, catching these negative vectors before they reach the final adoption decision. This makes trust a structural dampener within the behavioral ecosystem. Robust trust mechanisms actively absorb and reduce the negative statistical impact of perceived risks. Trust functions as the ecosystem's shock absorber, actively neutralizing the friction inherent in these markets. While linear analysis identifies these core relationships, it doesn't account for how these variables combine in the real world. To solve for that complexity, researchers used fuzzy set qualitative comparative analysis, or FSQCA. This methodology tests how variables interact in complex combinations, rather than in isolation. This visualizes the system as a series of logic pathways. The FSQCA results establish equifinality, the fact that multiple, distinct combinations of factors lead to the exact same adoption outcome. For instance, high security combined with significant economic benefit drives adoption, even if the system is relatively difficult to use. Conversely, exceptional trust and ease of use achieve the same outcome, despite perceived security risks. Equal finality proves that firms have multiple valid causal recipes for success, granting them strategic flexibility based on local market conditions. This complete conceptual model ultimately represents the finalized risk-trust architecture. Scaling digital finance here requires moving beyond a simple focus on utility and interface design. Developers and policymakers must architect products that specifically mediate legal and security vulnerabilities to prevent the degradation of trust. Where operational risks are unavoidable due to infrastructure, firms can structurally bypass those barriers by over-engineering economic benefits and trust mechanisms. The entire digital financial system can be engineered to work seamlessly in harmony with the local environment, rather than struggling against it. This extended framework serves as a quantitative blueprint for navigating friction and expanding financial access across the developing world.